All righty. Welcome back. Welcome back. This is the Intelligent Developers, led by Andre Bueno and Jerrod Delaine. And today we have fantastic guest named Keith Gordon. Keith, how you doing, man?
I'm doing great. And yourself? How you guys doing?
Good, good. Andre, how are you?
I'm doing very well. Thanks for asking. Excited for this conversation. First of all, congratulations, Keith, on breaking ground on the Ogden Theater Apartments. Sounds like that has been one of the more recent ventures, but would love to, kind of introduce you to our guests, have you talk a little bit about your background before we dive into some questions. How does that sound?
Sounds great.
Amazing, amazing. So, Keith is a part of that special little crowd that has had HBCU undergrad and Ivy League grad. So if you could please tell us a little bit, how was that Howard University experience for you?
Well, first of all, thank you very much. I think that, my closest friends that I have today are from Howard University and the skills I picked up there. I feel like I got an excellent education. I felt I was extremely well prepared. Went to Howard University, obviously in Washington, D.C. I think the nation's capital is also an excellent place to go to school and be at the seat of power. A lot has changed over there, but I think that's still the case. And the opportunities presented out of there with some of the recruiting that they had access to at Howard, as well as a lot of the student government and other programs that are offered through the university have served me well in life and in business.
Excellent. And where specifically did you get recruited straight out of Howard?
So out of Howard, there was at that time a lot of people of color the HBCUs were starting to break through on Wall Street, and so I was able to out of Howard to land a position at was Chase Manhattan and merged with J.P. Morgan, and they were went to their investment banking group. And my first position there was 2 years in the mergers and acquisitions group, where I was worried about doing well in accounting, doing training, and I actually did better than I thought and ended up in one of the most accounting focused groups in the investment bank, which was mergers and acquisitions. And I think later on in the interview, I'll tell you how that experience has boded me well. But there we focused on, we on a Friday afternoon, senior banker would say, I'm going to meet the CEO of, let's just say, Home Depot. And, we were trying to expand into lumber or something. Can you find me 3 or 4 acquisition targets that make sense? And I'm gonna go see that CEO and use your work. Now, that's just obviously not an actual example, but kind of assignments that I was given to go. And so what you learn there is how to, you have basically a banker that's going there for $1 million in fees and
Mm.
strictly advice. So if the quality of your work isn't there or your analysis isn't there, that banker would be embarrassed, and certainly that's not a good thing. So the work ethic and the attention to detail are two of the things I took from that experience.
And because you spent so much time as an investment banker, is that what kind of put you on that track to go and attend HBS and, following that, 2 years in banking, 2 years in private equity kind of framework?
Well, I think it was, yeah, in a way it did, right? So normal thing at that time, it still is that you would get a couple years of work experience and then you go back to MBA programs. For me, I actually did 3 years, and I think what separated me was that I had I worked for Johannesburg, South Africa, doing banking, and I got promoted. And so when you're going to HBS and they want you to be able to contribute to the learning of others. So you may be sitting in your section with someone that works for the Chinese government and someone that's an engineer background. So when you have in your case studies, you're discussing a case in a company or an actual, case, which obviously was a case method at HBS. You all have something, a unique experience to add, to the case and to learning of others.
And have you used that same kind of framework as you've been evaluating different investments or different opportunities?
Yeah, well, I think the biggest thing is that a couple things, and I think, and now to move forward to how it's helped me, but I think that later on currently, but I think you spend 2 years where every protagonist in the case. You're the protagonist and you're making decisions. So Harvard says we're trying to train leaders, right? So, everything has you sitting in the seat as a leader. And that sticks with me today, where, whenever I'm looking at making business decisions or something like that, the training is, it's, you don't know at the time, but, it teaches you how to think like a leader, how to make decisions. And so it was extremely beneficial. I think also, the network, it's not, it's not an analytical MBA program where you're running numbers all day and say, oh, I came up with the best mathematical equation or whatever. It's more so, more softer people skills, and that's a part of it. The analytics are a part of it, but not the main focus.
Fantastic. So you go to HBS, Harvard Business School. What was your next step from there?
Well, I think I take a step back. I went on full scholarship from JP Morgan to go to HBS. So my education was paid. So the original plan was to go back and complete doing investment banking. My last stint in investment banking was actually in real estate. So once I got promoted at M&A, I did a stint rotated abroad and then in real estate. So what happened is I was anticipating on going back to HBS, but after 911, whatever, it didn't turn out that way. But I was blessed to have a lot of flexibility because I had an MBA that was paid for. And so after that, I was looking at what I wanted to do, and I had bought a brownstone in Harlem that I still have, and four family, and I thought I could live in one unit, rent three out, I could get to work on 48th and Park, and get there by hitting the Metro North or the 405 train because from Harlem and get that. So then when I was thinking what I really wanted to do, I felt that I wanted to do real estate. And so I reached out to some classmates, and so I started my career after business school at Fannie Mae at the multifamily group.
Excellent. And you invested in Harlem,
Mhm.
enjoyed the appreciation, and kind of what was that transition of Harlem? Because Harlem has had a massive amount of appreciation from, the early 2000s to 2020.
Yeah, well, obviously I bought it pretty well in 2001, and the neighborhood has done very well. If I could talk to the person 20 some years ago, I would have, done a couple things differently. But I think that it taught me one, I did first rehab I did, and and also it was the first big investment I made. So, after that, I started expanding into doing, my hometown, St. Louis, where I'm from. I, started buying bigger buildings, and that started. And so I was kind of working a day job and continuing to build a real estate portfolio on the side. And then the second acquisition I made in New York was uh, a beautiful limestone I had in Bed-Stuy, an area called Stuyvesant Heights, that did extremely well. And actually, I took the proceeds of that and some of that when I sold it, and that's where you saw Ogden Theater. The down payment for that, like a long time ago. Actually, I leveraged that into building a $7 million new construction building.
Wow, but we're talking over the course of what time period here? Are we talking 2 decades?
Well, let's fast forward. So first, after business school, I worked at Fannie Mae, and then I started working for a REIT for a billionaire Sam Zell, where I was buying I was in that acquisition group. We are buying multi-family buildings, and we're buying 2 billion and selling 2 billion. So I saw the market rate side of that. So around 2006 or 2007, I bought the brownstone and Bed-Stuy. In 2009, they were pretty much going to tell me that I could give them cents on the dollar for the debt. It was so bad in 08, 09. And then at this time, career-wise, I was still, at Equity Residential. And then I started working for a company called Centerline Capital Group doing live tech equity. I was a tax credit syndicator. Along that time, around 2015, 2016, a buddy of mine came to me and said, "What would you do?" I was like, "Well, I really don't want to sell the building. It's beautiful limestone I had on Stuyvesant Heights, and to this day I loved it." And the wife's like, "I could live in Brooklyn, but I like I'm from the suburbs, so I didn't think it was an opportunity to move into it. And so someone, he hit the number, which is, more than double what I paid for it. And so I took that. And then at that time I had, went and worked for another developer around, probably 2017 and, or I'm sorry, around 2016, and then launched my own company. So I've been in business now, I think officially full time, probably 8 or 9 years now.
One day we're going to write a long case study, Keith,
Yeah,
about Ogden Avenue.
yeah,
But
yeah.
if you could give kind of a quick overview of the kind of start of your first big entrepreneurial investment.
Right. Well, the first one started with the brownstone, but how I really started with the real estate company with NCV Capital was the first deal that I put money down when I sold the brownstones was in March of 17 for Ogden Theater. And I was inexperienced developer, but I put a couple $100,000 on the land and struggled because I didn't break down to the end of 24 on it. But that was the first investment. From there, I was doing advisory work with nonprofits around New York City. And so, they gave me a lot of access to seeing how these affordable deals were structured. One I had seen from the LIHTC side because I was a LIHTC investor. And then I started seeing it, from the other side, the debt. And so from that, I was with in one of my, from that, I leveraged that to realize that a lot of these nonprofits had right of first refusals. So what that means is that they will be part of a transaction and they will need a nonprofit for the tax abatement, but at the end of that tax credit compliance period, the nonprofit had right of first refusal. So the first big deal I did was called Los Tres Unidos. And that was some big developers that put a down payment down on had put a big offer on for a building on Central Park North. And Jerrod, you're obviously familiar with that, this building, Los Tres. And so it's at 111th, actually, a block up. And so the nonprofit had a right of first refusal. And so they called me and said, hey, we have a small percentage of this deal, but we need to match this $42 million offer, whatever the offer was at the time. And I was able to put a team together to acquire that property to go ahead. And we obviously stayed in the deal. It's recapped at a very, very handsome, return. And we're still in the deal and looking to with our partners, looking to build on the parking lot to that Section 8 building. So that was the first investment deal that I actually closed. Now I put the money down on Ogden, but didn't own it. It was just a down payment. And but Los Tres Unidos was the first deal that NCV closed of scale. We kind of took it from there.
Understood. And I mean, you're talking about really sequencing capital, right, through all these conversations. You talked about equity and debt, tax credits,
Yeah.
structuring joint ventures. Like, if you were, I guess, talking with an emerging developer, how would you kind of prioritize where they should be focused on to scale their platforms like you have?
Well, first I think, you got to have a vision, right? Or you want to do new construction, you want to do rehabs because, I guess without a vision, the people shall perish, right? Meaning the most successful people I've seen have been, kind of on a straight, narrow, like this is what I do. The other things, there's just some loose thoughts or 2 or 3 points. I think one is that as long as you get your deal, the main thing is to get your first deals done, right? A lot of times you're trying to haggle here and there, and I made some mistakes. I want this percentage, that percentage. But a lot of times what you find is a person with the smallest percentage can end up with the whole deal, right? So the point is to get your first deal done. On Ogden, it took me a long time to get there. I had some offers, but had I maybe brought on a bigger partner earlier, I'd be doing on the second or third new construction deal. So that's that. Then the other thing I would think about is really thinking about what you want your role to be. I mean, you start out and say, oh, I want to be I want to be the majority in this deal and I can run this deal. But, until you sit in that seat and see what it takes day to day to make it, you don't know, you can agree to perform tasks and roles that you're not set up to do. Right. So my point is to be realistic of what you bring to the table. The second is that, a lot of people that I've seen say, oh, I'm gonna go out and raise a fund. I'm smart. I'm gonna go raise a big fund. But I think the first thing I would be trying to do is close the deal, right? And so therefore I built the business doing one-off deals, with investors. So, the deal finds the capital. So I think if you find the right deal, you'll find capital for the deal. Um, so I think focusing on raising a blind pool of capital without having actual deals I don't think I would go that route. I think I would find specific deals and find investors for that specific deal opposed to raising blind capital.
And I was kind of, doing some research on you, and I saw that
Mhm.
you had done that 515 home project over at, was it called Mount Hope Renaissance?
Yes. Yeah.
How did that deal come about? That was more of a preservation deal, is that correct?
Right. It was a preservation deal. You know, um, well, that deal there, I started doing advisory work for them. Actually, I started while I had my last. I worked for a developer for 1 or 2 years, and we had worked with this group, Mount Hope, for a piece of land they had on in the Bronx. And so they brought the relationship, and they said, well, listen, we've got this huge portfolio, and we need some help, right? We need some help raising capital for it. So I started off in the advisory role, working to try to raise some capital. And then what I realized is that the capital sources say this is creating a lot of, they said, it's in disrepair, it's got a lot of violations and stuff. We think that we need somebody else to run the deal. We don't want to put money, we don't want to put good money out of bad. So we need someone that's there to be the leader of it and take it forward. And I said, well, look, I've just been an equity, I've just been a, advisory in this role on a deal this size. And so I was able to put a partnership together, and it was to turn into $100 million deal, which started as an advisory assignment where we were on the worst. It was on the worst. It was on the public advocate's worst landlord list. 1,500 violations on a portfolio. Now it's well under 400 to 300 and declining. And so yeah, so what that did was that exposed me to operate the deals myself. On the first Los Trades, I had other partners in there, and they took the lead in terms of day to day. But here, that's where I learned to operate buildings in New York City. And so that was an excellent deal to, like I said, that's when I felt like I'm a real developer in New York, when you're running day to day on a project that size, and the residents are benefit for it. And it is a it was a unique structure at the time, but where instead of using, it was originally rehabbed as LIHTC, a lot of those buildings, but we rehabbed it through a program through HBD called the PLP, Participation Loan Program, which is really, instead of using tax credit equity, we funded the deal with actual equity, tax abatements, and low interest soft money from the city. So I think that's where New York is thinking out the box. And whether works out like they planned it or not, who knows? But that's how that's how we funded that deal and how it was structured.
And on that particular deal, you partnered with a larger established minority development firm. Can you talk a little bit about that?
Right. So I was friends with a guy, Harris Rayford from Lamore Development, and Ken Morrison. So, at that time I went down to the city, and they said, well, listen, it's $100 million deal. You're starting out, you got a good resume, you think you're smart, but you know, if you haven't run a deal, it's hard for us to commit, you know, on $100 million deals, hard for us to commit hard-earned taxpayer money to an inexperienced developer. So you ride shotgun on this one or whatever, and or partner with someone else bigger that had the experience. And it's been, from an operational standpoint, it's been very good because I have partners that allow me to grow. I think that's another thing when you find partnerships, is to find partners who allow you to grow your own business. And that's helped me out tremendously, and getting the experience I need to operate other portfolios that I own, and that. So yeah.
Beautiful. Now, I want to circle back to the M&A thing we talked about earlier. How
Hmm.
are you able to now kind of pull forward some of that knowledge you learned in business school?
Right. Well, I mean, obviously, Jerrod, you've known me a long time. So I think the main thing is just that I was listening to a guy, Dennis Kimbrough. I think he did he took off, he did a takeoff of Dale Carnegie's book. But long story short, he said that basically he don't know why minorities were starting businesses from scratch, because if you have an established business, you got systems in place, you got a customer base in place. Um, and so what I thought was, I was sitting there saying that maybe 2 or 3 years ago and felt like, man, I'm outgrowing my platform. I can't to grow this business. I'm either gonna continue to build it, which took me forever to get to build systems and stuff. Either I was going to joint venture or I was going to buy, had to buy a platform or something to allow me to grow. And doing M&A, what saw a lot of times every week, I was putting these books together where you do, okay, this company wants to acquire a strategic partner. I mean, I'm sorry, wants to make an acquisition. These are the synergies. This is how you save. This is how you grow. I even saw a couple cases where smaller companies bought bigger companies, and that's what happened with Chase and JP Morgan, with Chemical Bank and Chase, where Chemical Bank, actually was the controlling interest of the Chase Manhattan Bank after that. So from there, I was looking for, kind of a platform to play on. And so I was doing advisory work and working out a lot of transactions for companies that were managed by a property management company called Prestige Management. And, currently they were, I always thought that I said, listen, I really admired the company. They had been businesses to the early 90s. And so when the founder was transitioning out and the other partners who stayed in there, the other three partners who stayed run the business, I decided to partner with them and acquire a piece of the company and take an operational role. And so it went from me being a local developer in Northern Manhattan and the South Bronx to all four boroughs. And the scale is I feel like the responsibility is bigger and stress is more, but I feel like the platform is much bigger to play on. Who knows what, I made a decision to go from a small niche business to a bigger one, but and that just happened in the last 6 to 9 months. But I'm making a bet that this platform is going to allow me to be a much bigger player in this New York market than what I could have been with my existing platform.
And if you were to start your career over again and you were starting today, you were an emerging developer and you were wanting to get on this path of really becoming institutional grade, assuming you had, the right thesis and, you have projects specifically that you're looking to break ground on, what advice would you be giving them as we look at the capital markets and the instability of our political system?
Well, I think a couple things. One, I think, it's better to be 10% of 10 deals than 100% of one deal, right? So it's good to spread out among other deals, right? So, you want to, instead of trying to just own all of one, you'd rather spread yourself thin to hedge your bet to mitigate against the risk, right? The other thing that comes to mind is how I built my business was much different than a friend of mine, but, whereas, essentially I got frustrated because I was going into these minority groups working for a majority firm and, and it wasn't an opportunity for equity. So I felt, like I'm looking at these eyes and trying to provide housing for people of color and things, mainly of people of color, not solely, but, and I'm not in the equity ownership. So I started my own firm, and just started going, eating off advisory and doing that. I would not do that today. It's just too hard. It's too hard to gain traction out here. And it's too risky. What I would do is find an established developer, I'm doing a shameless plug for my companies like myself. And I think what I would do is work along the platform because it gets you there much faster and easier working along someone that has established relationships with financing, with banks, lenders, and the overall market. And then put my head down 3 to 5 years and work with them and then see where it goes. I think that's a much more systematic and a path that will give you a higher chance of success than just going commando out here saying I'm a developer and do that. The other thing is that it always takes you more time to make money in this business. If you try to close a new construction deal, you take a couple years to get it closed, and it's 3 years before you can really make any real money. So I think just always assume that it's going to take you more money than you thought and longer time you thought to make your company profitable. And but yeah, those are some things I would advise I give to some emerging developers.
And then the last question, Keith, as if you've mentioned in your stories about the growth that you've achieved. Can you provide some advice for those looking to fundraise to do the first deal, second deal, fifth deal? What advice would you have for those?
Well, I think I need to be listening to advice, right? Because I think the problem I've had is that I've tried to use my own capital, and it's like being on a treadmill, right? It's like, okay, I close, you close the $7 million deal, but you got a billion, you got a $500 million pipeline, right? So I think that, I'm learning that, you know, you need outside capital to grow your business, right? And so in how you fund it, I mean, that's the question, whether you go to a strategic partner, whatever, to fund your business.
Hmm.
And there's one other point I wanted to make. I mean, I think the main thing is that raising money is also a full-time job, right? I mean, right at this point, we've got, 1,500 units, but now we manage 15,000 units, and we've got a huge pipeline right now. Um, and I've got a couple kids, so it's hard to get out there. When you raise the money, I don't care if someone say I'm gonna meet me at the gym or after coffee at 6 a.m. You got to be there. I don't care if it's 8 o'clock at night. I mean, and or 9 o'clock at night, and someone said, "Hey, I'm just catching a flight in. Meet me for a beer in my, meet me for a beer, where I'm staying or whatever." It just takes so much time and effort to raise money, and so I think I would underestimate that. And I'm just saying that one of the challenges you have as a small developer or whatever is that you can only wear so many hats. There's only so many hours in a day. And raising money, don't be naive about it. Raising money is a full-time job, and so you're in this perplexing situation where it's like, I need more money to grow my business. And I'm so busy running what I have and trying to run my day to day. How do I marry that with time to get out and spend that necessary time and effort to raise money in addition to that.
Fantastic. Keith, thank you, man. This has
Thank
been
you,
great.
guys.
We truly appreciate it.
All right. Thank you, guys.
Thank you, Keith.
Yeah, thank you,
All
guys.
right. Bye.